everyone, and thank you for joining us today. Above all else, we hope you are keeping safe and well at the moment. Now, COVID-19 is first and foremost a human health emergency, but given the economic shutdowns worldwide the pandemic has prompted, we also have a severe disruption on our hands in markets. Because of that, it's been quite a ride for investors and market watchers in the last couple of months. While everything is flashing red though, there are some important things to remember. Yes, markets are down, but there's been a strong rally in recent weeks in Australia. Yes, everything feels uncertain, but there is one certainty you can hang on to, and that is that this will pass. The key for investors is to make sure that they're in the right spot for a recovery. Now, our Chief Economist and Head of Investment Strategy, Shane Oliver, will be with you shortly to give a market update and share his wisdom after having been through many a market crash in his 36 years at AMP Capital. A reminder before we get started that CPD points are available for those who attend the majority of the webinar, and the slides and recording will also be made available to all of you after the event. As I said, all of that information will be made available to you after today's recording. Also a reminder for all of those that have spotted, it is of course 2020. Please excuse the 2019 typo on the opening slide there. For now, it's over to you, Shane.
Thank you, Katerina. And here I am from beautiful downtown Avalon. Didn't think I'd be doing this, but here we go. So the last time I did a webinar and updated on these issues was about 6 weeks ago. So it was in the first half of March. And of course, since then, things have got a lot worse in some ways. Share markets fell a little bit further after that event, but of course have had a good rebound since then. But of course, a lot of uncertainty remains. So I'll run through how we see the coronavirus situation itself. I'll run through how we see that impacting economies, and then I'll also come back and look at investment markets, which I think is probably the thing of greatest importance for investors. But as Katerina pointed out, this is first and foremost a human disaster, and we all have elderly parents, elderly friends, and those people are particularly vulnerable. So I'm quite thankful that the Australian government has done what they've done and got this under control, such that if we or particularly elderly Australians have to go to hospital, there will be help for them. Whereas if we didn't get it under control, that would have been a really big and horrible situation. So I've got a bunch of charts here. Hopefully we will soon move on to the next one. I did push the button there, but it didn't move. I've got to click on them. Sorry, here we go. I'm going to zip through some of these slides fairly quickly. The first one you will see is the disclaimer, which is the normal disclaimer we do. And of course, I'm not providing specific investment advice here. If you do want investment advice, you have to go and see a financial planner or get that from someone else. I'm not qualified to do that. So if we move on to the next slide, which will pop up there, just gives a bit of perspective. I think it's always important to put share market moves in historical context. And you can see there the US share market in blue and the Australian share market in red. Big dip. That dip from around about February the 20th to the low, which was around about 23rd of March, was about 36% in Australian shares, 36.5% to be precise. Global shares was around 35%, and the US share market was about 34%. Sounds on that basis we're a little bit worse, but don't forget Europe fell 38%. So in the great scheme of things, we're in the middle of the pack. Now you can't quite see it on that chart, but there has been a rebound since then to their recent highs, which was a week or so ago. And of course, just the other day in the US, markets have rallied more than 20%. Aussie market had a rally of about 21%. US shares up about 28%. So we have had a pretty good bounce, but we're still well below the highs prior to the coronavirus shutdowns occurring. So obviously market's still a bit uneasy in that sense. How do I see things? Quick summary here, very quick summary. We're going to take a big hit to economic activity in the current half year, mainly in the June quarter, because don't forget the shutdowns kicked in through the second half of March. So the bulk of the hit to economic activity will occur in the June quarter. Through the second half of the year, I think we will see some recovery. And to be honest with you, I feel a little bit more confident on this now that 6 weeks have gone by. If you go back to the first half of March rather, in fact, through March generally, there was a lot of talk that the shutdown in Australia would go for 6 months, whereas now we're increasingly seeing signs that the coronavirus situation is coming under control, and there's talk of an earlier easing, probably in May. In fact, some states have already started to ease up some of those restrictions. but I think that will become more noticeable as we go through May. So that gives me a little bit more confidence that economic activity will return. That doesn't mean we'll be able to get on planes and fly overseas. I think that'll be the last thing to come back in the absence of the virus, but it does mean that the big hit to economic activity that came from keeping people in their homes, not being able to go out, not being able to go to work, all that sort of stuff, that will start to reverse to some degree. There'll be a lasting impact, but we will start to see growth again. Now, we are in a world of very low inflation. I think that will continue. Slightly higher inflation in Australia in the March quarter. That was mainly due to the drought and the bushfires. If you abstract from that, still very low, but you are going to see a big hit to inflation in the months ahead. Obviously, retailers discounting, the collapse in petrol prices, just drive around and fill up your car and see how much petrol prices have come down. Free childcare in Australia, a whole bunch of things. Big thing though will be a rise in unemployment causing lower wages growth, which ultimately will mean lower costs coming through and also discounting on the part of retailers. We are seeing a lot of monetary and fiscal stimulus. That I think is key here. If I go back to 6 weeks ago, we're only just starting to see that. Now we've seen that really ramp up. So yes, there's a hit to economic activity, but we have seen a response by governments, which I think is very important. Very good response, I think, in Australia, focused on the JobKeeper wage subsidies, which I think are important because they preserve the link between employers and employees. If, like the US, they're all just laid off and then encouraged to go on unemployment benefits or job seeker, then it's much harder to re-employ those people again down the track. Whereas this arrangement keeps that link going. And so when the time comes to start businesses up again, then it's much easier for the employer to say, okay, look, I'm reopening the hairdressing salon or whatever it is, come back to work. I think that's a very positive move by the Australian government, targeted at protecting 6 million jobs, which I think is very important, and also a rapid response by the Reserve Bank, making it easier for banks to provide those mortgage and business debt payment holidays, which I think are very important. Now, in the very short term, there is some risk that share markets might go through a bit of a wobbly patch. They came down very heavily into March. They've had a bounce. They've had a good rally. We are going through a period of tough economic data, bad profit news. Could still be some uncertainty about the coronavirus, talk of second waves and so on. So you could easily see a bit of a pullback in markets. You know, I don't know about the short term. There is still that risk in the short term. But on a 12-month horizon, I'm reasonably confident that markets will be higher than where they are today. And I'll go into some of that a bit later. There's some things there about what to watch. I think the main one is the length of the shutdown. Go back a few weeks ago, talk of 6 months. Now it looks like from somewhere around second half of March to somewhere in May, so maybe around 2 months, so not quite as bad as had been feared. I think the key in all of this is to minimise collateral damage to the economy. I think that's critically important. There will be some businesses that won't make it through this, but I think the various initiatives the government has put in place, very low interest rates, all those sorts of things mean that we've got a good shot at keeping the bulk of businesses going, and therefore it won't be as long lasting as, say, a normal recession, let alone the Great Depression back in the 1930s. So if we just zip through some of these pictures here, which I'll do, you can look at these at your leisure later. That one didn't seem to move. Make sure I click that. Here we go. I used this slide last time and it gave me a bit of confidence that Australia had things on track because we were well prepared for a pandemic. Of course, I should have looked at North America there. And then a little while later, there was Donald Trump brandishing the same slide. So that's got me a little bit worried about things. And of course, we have seen a bit of mayhem in the US, partly because of their lax initial response, which I think wasn't the best, whereas Australia, I think, has done a much better job on things. Just moving on. This is what's happened. The left-hand side slide there shows coronavirus cases per country divided by population. And you can see the good news, Australia is down there, the bottom right, with Korea, Japan and China. We're not up there with Spain or Italy or the US or even Singapore or France or Belgium. I mean, that's a good thing that we have been able to flatten the curve. I should point out in Singapore, a lot of people say that's an example of a second wave. I'd also point out it's an example of having too many foreign workers living in close quarters in a dormitory. That's where the problem has really come in Singapore. So I don't think it's a good example of a second wave. and the second wave looks like some of those graphs from 1918, 1919, where you saw a big rise in the number of cases, then it came all the way back down, then it goes all the way back up again. We haven't seen that in Singapore or Japan. I just don't think they really got it under control in the first place. So they're not good examples of second waves. The one that excites me, of course, or gets me somewhat confident, is the one on the right-hand side. Since about late March, we have seen the number of new cases of coronavirus globally trend sideways. I think that's a positive sign that it's starting to come under control. It varies from country to country. Obviously, Europe looks better. And I'll just go through 4 countries here. A lot of people say the Chinese data is unreliable. Yes, there are issues there. I think to be honest with you, I think there's issues with everybody's data. The reason I put the Chinese numbers up, and I have done right through this whole episode, is because they show that lockdowns work. Initially, they perhaps denied there was a problem, thought there wasn't an issue, then realised there was a problem come late January, and they announced severe lockdowns. And about 2 or 3 weeks after that, we saw a peak in the number of new cases in China, either in early February or around February the 12th, which is that second spike there. You can debate which one it was, but sometime in early February, the number of new cases spiked or peaked in Japan, and then it came under control and they were able to ease their lockdown. So that gives us a sort of a timetable. Yes, the data is not precisely right, but it's a rough guide. And interestingly, Italy saw exactly the same thing. Initial problem, they didn't realise what they were seeing here, a sense of denial perhaps. Then they realised they have a problem. They announced big lockdowns, particularly number 2, the vertical line number 2 there. About a few weeks later, late March, guess what? The number of new cases in Italy starts to slow down, and it's been slowing ever since. It would have been nice to see it slow faster, but it has been slowing down, which has enabled them to announce some phasing down of their lockdown. Very minor at this stage, but that's the direction they're heading in. Similar story in Australia, same thing. Initial problem, no, it's under control, no worries. Then we start to hear, well, there is a problem here, we've got to get it under control. We announce the lockdown, and in Australia's case, within a week or so, it started to come under control. So I think that's a very positive outcome. Now, if China is any guide, China's, I guess, peak period of concern was late January, early February. February turned out to be the low point for economic activity in China. And I think you could say that for Europe and Australia, April or maybe May will be the low point in economic activity in these 2 countries, and Europe more generally. Now, the US, similar pattern, initial problem, bit of denial there. Then, of course, they realised, yeah, we have a major problem here. They announced the lockdowns, and we have seen a peak, I think, in the number of new cases, but it has taken longer in the US. But I think we're gradually starting to see a downtrend emerge in the US as well, which is why some states in the US are sort of heading towards some easing of the lockdown. So that's all quite significant, because if you go back just to April the 7th, that was the last time we heard Scott Morrison talk about a 6-month lockdown. Now we hear talk, we're going to have a meeting in May to potentially ease things up. So I think that's a very positive change, that we've been able to get it under control, keep our healthcare system operating, minimise the number of deaths. And I think that gives me some confidence going forward. If I move on to the next slide here, this is quite important because it shows a comparison of Australia versus other countries. Now, I'm not going to go into all the numbers there, but what we've done is ranked Australia relative to 50 other countries, the top 50 countries in terms of coronavirus cases, and guess what? Australia ranks number 2 in terms of recovery rate, testing per head of population, active cases per capita, and so on. So we have adjusted for the size of Australia's population. So it is a relevant comparison across countries. We rank number 2. And you can see down the bottom there, US ranks number 47 and UK ranks number 49. So we've done a pretty good job here, I think, in Australia, and that has meant that we've been able to keep the death rate down because we haven't had our healthcare system being inundated, like would have been the case if we let it get out of control. So I think that's a pretty important positive for Australia and will help us going forward. And I'll come back to that point in a moment. If we just move on, obviously a big hit to global economic activity. This chart shows since 2005, world GDP in red, and the blue line is a measure of business confidence. And you can see big plunge into March, almost back to levels at the times of the GFC. If I update it for the world's, well, the top 3 developed countries, US, Europe, and Japan, update and put their data in for April, and it shows a further sharp fall in business confidence globally. So we're going to get a hit to economic activity based on that chart there, greater than what we saw at the time of the GFC. That's why you hear all this talk about a 10 to 15% hit to economic activity, worse than anything we've seen in the post-war period. You've got to go back to the 1930s to see something comparable to that in terms of the scale of the hit. So if I move on to China, I mentioned China earlier. They saw a 10% reduction in their economy in the March quarter because of the lockdowns. That's the sort of thing we're going to see in the current quarter in places like Australia and the US and Europe. Could be more, could be a bit less, but something of that order. Won't be so good. The thing about China, though, is that once they started to ease their lockdowns in late February, going into March, economic activity indicators in China started to bottom out and gradually head back to normal. So what I've shown here is data for traffic congestion. And you don't need to rely on government stats for this. You can just look at webcams to get an idea of that. And that's, I think, where they get the data from. Coal consumption at power stations, property transactions. I've also got data on air travel, and they all look the same. Big hit into late January, which is the normal holiday period in China, but then not much of a recovery, unlike normal. And then as we go through March, a return back towards more normal levels of economic activity. And out of interest in air travel in China, domestic travel has gone about 2/3, 3/4 of the way back to normal activity. Global international travel into and out of China is, of course, still way down because they had to shut that down because of imported cases coming in. So China gives us a little bit of hope. If February was the low point in China, and they're, say, 2 months ahead of us and Europe and the US, then maybe April, May is the low point in the rest of the world, or at least in US, Europe, and hopefully Australia. So that gives us a bit of a time frame to work on. If I move on to the next slide, which shows the US, I mean, US economic activity looks horrible, like everybody else's. We're going to see a big spike in unemployment. There's some unemployment figures coming out next Friday, not this coming Friday, but the one after, May the 8th, and it's probably going to show unemployment in the US up around 15, 16%. We've seen a big spike in unemployment claims in the US. 26 million people have filed for unemployment claims in the US. Horrible numbers there. That's why I think the JobKeeper scheme in Australia is a far better outcome than boosting unemployment benefits, because it keeps that relationship between the worker and the employer. So it's pretty horrible data in the US. If I often very hard to track these things because most data comes out monthly, but there are things you can track on a weekly basis, almost on a daily basis, and we've done that in that bottom chart there where we've called that a US economic activity tracker. And it's based on a whole bunch of things which are listed, air traffic, restaurant sales and all sorts of things, jobless claims and so on. And you can see that momentum in the US is still down as we went into about a week ago. So that's not pretty. I suspect that indicator will soon start to bottom out. But all those high frequency indicators tell us that the US economy has fallen very, very sharply. If I move on to the next slide, this just sort of gives you some sort of pattern as to guide as to how we see things. Very hard to be precise here. Both the federal government and the Reserve Bank at present are saying, well, it's too hard to provide economic forecasts. We've got some here. We've got a base case here, which I think so far is roughly on track, and that is you get a detraction in world economic activity in the March quarter, mainly due to China, but other countries will go backwards a bit as well. And then an even deeper contraction in the June quarter, and then a rebound in the second half. Now, I should point out here that the top two numbers there, that's quarterly annualized. So we've taken the quarterly rate. So if you take the US down 40% in the base case in the June quarter, that means it's declining 10%, and we've multiplied that by 4 to get the annual rate of 40%. And you can see the worst case assumes that it takes longer to get things under control, takes longer to end the shutdowns. The key thing to note from all these charts, though, is that they do look like a deep V recovery. But if you look at the level of economic activity, it takes a lot longer to get back to normal. So if you go down by, say, 10% and then you have growth of 5%, you're still a long way from the high. And that's effectively what will happen here. It'll take a long time to get back to normal economic activity. In fact, on our projections, we don't get back to the December 2019 high point in global economic activity until the end of next year. So I guess that's a bit of a dampener on all of this. Growth will return, but it'll take a while to get back to normal. I guess, the swings and roundabouts here, that does mean that interest rates are going to stay lower for longer. In Australia, I reckon we're stuck with a 0.25% cash rate probably for the next 3 years. So it does mean lower for longer interest rates. If I move on to the next slide, some signposts here. These are things that we've been tracking regularly over the last few weeks. We thought, it's very hard to look at a single indicator here. We're going through a situation which has not been experienced globally, unless you go back to 1918, 1919, which was complicated by the end of World War I. And in any case, economic data back then wasn't so good. That was the time of Spanish flu. So what we're looking at is 4 things: control of the virus. I won't go through all of these things. Policy support from governments to help us go through a period of hibernation, so that we don't, like a bear, we don't die in hibernation. Collateral damage being kept to a minimum, and also signs of a market bottom. If I run through these things, there are positive signs in the virus coming under control. Now, that doesn't mean we'll be able to go back to everything as normal. It's quite possible in the absence of a vaccine that global travel will take a lot longer to come back, and we might ultimately just have to rely on antivirals, much as the case with HIV. If you think about it, HIV came along back in the 1980s. I remember at the time they'd say, well, a vaccine is at least 12 months away, and here we are still waiting for a vaccine for HIV. So, but it has been treated with antivirals. That may well turn out to be the ultimate solution with coronavirus. Hopefully a vaccine does come along though. But I think the point is that there are positive signs here. Shutdowns appear to be working, and now we can start relaxing them a little bit. We have seen a lot of government support for economies. That ticks off. There's a little chart there on the right-hand side bottom which shows fiscal stimulus as a share of GDP. And you can see there that it's way above what we saw at the time of the GFC. And Australia actually stands out on that front. In Australia, it's pushing around 10% of GDP, which is quite high. And I should point out that Australia, that 10% of GDP is actual government spending, whereas in the US, it's often loans as opposed to pure government spending and tax breaks. I guess we can get into all sorts of philosophical debates as to whether government should do this sort of thing, but I think this is a black swan event. It's not related to businesses taking on too much debt or households taking on too much debt. Therefore, I think there is a role for government to jump in through this period. If you don't do that, if we didn't do that, then it would take us a lot longer to recover once we get the virus under control. So I am pretty thankful that economic common sense has prevailed here. Can we pay it off? I'll just point out quickly for Australia, we have a level of net public debt which is 1/4 of what it is when you average the US, Europe, and Japan. So our level of net public debt as a share of our GDP is about 21%. If you average the US, Europe, and Japan, it's about 80%. So we've got a lot more scope to do fiscal stimulus than they have. So I think in Australia, it is to some degree it is affordable. The other thing to note about Australia is we borrow from ourselves. It's basically, those of us who are working at home, we're not out there spending as much. We're still getting a salary. It just goes into the banks. The banks are flush with cash. What do they do with it? They buy government bonds. So the government is borrowing it off those Australians who have spare cash and directing it to those who really need it, which I think is a sensible thing to do. It's classic Keynesian economics. Can the Reserve Bank print money? Well, you can get into a debate about that one as well, but I think it's appropriate for them to provide cheap loans to the banks so they can provide the bank payment holidays. If we had high inflation, then you couldn't do that, but we don't have high inflation, so they can do that. So I think that all makes sense. Where we're still waiting for more positive signposts is in relation to credit spreads, default rates. We're still going to see what unfolds there. Business surveys are still fairly weak. So that's still some question marks about those things. If I go back to March, looking at markets, we did see panic. We did see blood on the streets back in March. So maybe we have seen a bottom there. I think it's very hard to be definitive on this, but there is some chance that we have already seen the bottom in share markets. As I say, I don't want to be definitive. I don't know all the answers regarding the short-term moves in share markets. I don't think anybody does. And I reckon if you go back to March the 23rd, where people were predicting, we're going to have a 28% rally in the US share market, 21% rally in the Australian share market, I don't think many people were actually predicting that, so they would have missed out on that. So very hard to time markets in the short term, so very important to realise that. The point about all this is that many of the signposts are starting to tick off, which I think is a positive sign. If I move on to the next slide, monetary easing, I've already talked about that. Obviously, when you take interest rates to zero, not much more you can do. What do? You do quantitative easing. So they're doing that in two ways: buy government bonds. In other countries, they buy corporate bonds. In Japan, they're even buying shares, some shares, ETFs, and so on. In Australia, it's buying government bonds. They've done that, and they provide cheap loans to the banks, all of which increases the balance sheet of central banks. And as you can see, those balance sheets will rise in size relative to the size of their economies. Australia is starting down the bottom there, so we've already got we haven't done QE over the last decade like other countries have, so we're starting from a low point. One of the things to note about that chart is that there's no optimal level for the size of the balance sheet. Look at Japan's way above, and Japan keeps motoring along, albeit relatively slowly. So there's no right or wrong answer as to what the balance sheet should be. So it's quite conceivable that the central bank just holds those bonds for a lengthy period of time, just keeps rolling them over, which makes it easier for government to finance that debt, obviously at very low interest rates. If we move on to the next slide, obviously this phenomenon gave us a bit of a boom to economic activity in the March quarter. I don't think it's enough to stop the economy going backwards, but people piling up on toilet paper, rice, flour, pasta, tissues, hand sanitizers, office equipment, and so on, that will help March quarter GDP growth a little bit. Flip side, though, is that other things will probably decline, and so we'll probably see a small fall in the economy in the March quarter. If we move on to the June quarter, it is going to be more negative for Australia. I think that's pretty much assured. I've got some forecasts there. Again, if you look at the bottom right chart, I think it's going to take a long while before we get back to the level of economic activity we had at the end of December last year. But the point is that if the virus continues to come under control, we start to ease the restrictions as we go through May in a more substantive economic sense, as opposed to allowing more than two people to get together at once, then I think we will start to see some of that economic activity come back. If I go to the top left chart in Australia, we've put together a little indicator. A couple of great people in my team did this. Deanna Messina did the one for Australia, and a guy called Scott McElroy did the one for the US. But again, looking at a whole bunch of things like credit card data. You know, I'm at home, I'm not spending as much on my credit card, so that's giving a bit of a slump. Job ads as measured by SEEK, consumer confidence, and so on. This data all comes out on a weekly basis. Foot traffic through shopping centres, through cities and so on. So you can track all these sorts of things. You can see that big fall that occurred into late March. The interesting thing is it's stabilised a little bit since then, suggesting that the slump in Australian economic activity might have stabilised. We may be starting to bounce, to track along the bottom. Obviously, some economic numbers are going to look bad, so I've got some of them in that little table there. Unemployment probably heading to somewhere around 10%, maybe 9.75 if we're lucky. If things take longer, it goes to 15%, but the job keeper arrangement will probably help on that front. Just finally on the Aussie, the Aussie dollar, I reckon it may well have seen the lows. It went to 55 cents, always hard to time these things, but if you just think about it, we're not printing as much money as the US is. We've got the iron ore price at around $82, $83 a tonne, whereas something we import, oil, has collapsed in price. And we've done a good job of controlling the virus. So it may well be the case the Aussie dollar has already seen the bottom. And just on house prices, I think they are going lower. I'll come on to them in a moment. Just moving on, I think we'll start to see CFAs reopening from May. I've already gone through some of this. International travel will be the last thing to come back. So the bulk of the hit to economic activity will be through the current half. Start to see a pick up in the second half. I should point out that the main reason for that hit to economic activity, just to stress here, is not because of international travel being banned. It was because of us being told to stay in our homes. So if we start to get out there a bit more, that economic activity could start to come back, and international travel is really cream on the top. Now, there's three things that give me a little bit of optimism on all this regarding Australia. One, we've done a better job of containing the virus. I mentioned that one earlier. Two, we've seen a better stimulus response than I think in many other countries, which have been focused more on loans, paying people unemployment benefits and all those sorts of things. I think we've done a better job in Australia, and also we do have exposure to an economy which experienced the virus earlier and has now started to pick up a bit. So that should help us to some degree. Now, obviously, we have an Achilles here where we have high levels of household debt, but providing these other things help our economy recover faster, then it should prevent major problems in terms of household debt and delinquencies for the banks. Just moving on to share markets, valuations show shares as cheap, and we're looking at a whole bunch of indicators here and combining them into little gauges for Australia, Europe, US, and Japan. And they do look at things like PEs, dividend yields, and so on. Obviously, there's going to be a slump in earnings. Obviously, there's going to be a slump in dividends, as there was at the time of the GFC. But the GFC low point in March 2009, despite big falls in earnings and big falls in dividends, was a good buying opportunity for those who were brave enough to go in then. And we've also obviously allowed for lower interest rates and lower bond yields. So shares are relatively cheap in this context. Just depends on what sort of time horizon you have. Similar sort of thing here. I don't think the grossed up dividend yield will stay around 7-8% because dividends are going to be cut. NAB told us that the other day, and various other companies have cut dividends. But it's probably going to be around 4.5-5%, which is a far better return, cash flow return, than you can get on bank deposits, which have gone down to 1% or thereabouts. So that comparison is still there. Once investors get confident, well, maybe the share market's seen a bottom here, and I'm getting a better cash flow than I get on my bank deposits, then some of that money will start to go into the share market. Just moving on from that, history of bear markets there, go back to 1900, there's been quite a few of them. The worst one was in 1973-74, which of course is when my favourite TV show, The Brady Bunch, was canned. So it was a kind of depressing time. I sold all my shares. Well, I didn't, my parents did perhaps, but Aussie share market fell 59%. It is just worth pointing out that, yeah, you do get deeper falls when you have a recession, and we're going to be going through one here. Some people might call it a depression. I should point out that the reason people would say it might feel like a depression is the size of the contraction in the economy, say 10 to 15% in the first half of the year, will be something more comparable to what we saw at the time of the 1930s depression. We haven't seen anything on that scale in the post-war period. By the same token, it's very different. We didn't have the roaring 20s going into this. We actually had relatively constrained economic growth in Australia. The big concern was, how come we had so much underemployment? How come economic growth was so weak? How come inflation was so low? We didn't have central banks raising interest rates. In other words, we didn't have the boom that normally gives you a long and lasting bust. Rather, we've had a government decision to shut down big parts of the economy to get the virus under control, which I think was the correct decision. But it's a very different situation to what happened in the 1930s or in any of our recessions in the post-war period. So therefore, arguably, we should be able to recover faster, particularly if the shutdown ends fairly soon or starts to be phased down fairly soon. But the point about that chart is that bear markets do happen. Sometimes they're short, sometimes they're long, sometimes they go for 1 month or 2 months, like in 87. Sometimes they go for, I think there was one back in 1937-42, go for 61 months. But it's also very hard to time the recovery when precisely that occurs. And you can see there that you do get quite strong rallies after bear markets end. Just moving on to next slide there. Obviously, unlisted assets will take a bit of a hit in the short term, as some of those assets will be written down in value. But it's also worth pointing out that we are in a world of lower for longer interest rates, which will ultimately help those assets to some degree. So if we move on to the next slides, Aussie property market, I think it's starting to roll over in Sydney and Melbourne. If I look at the latest data from CoreLogic, and it comes out daily, looks like Melbourne prices have started to fall, albeit very slightly, and Sydney prices might be starting to roll over as well. Now, I've got a whole bunch of conflicting influences here, which are going in different directions. On the one hand, a lot of Australians are saying, well, I was going to sell, but I'm not going to now, so therefore that constrains supply. The reason they don't want to sell is that they want to stay at home and not mingle with a lot of people in the process of moving home. So they put that on hold. So that's led to a reduction in supply. We've got lower interest rates. We've got the bank payment holidays. We've got the JobKeeper scheme. All of those things help the property market hold up. But I do think we're going to see a big slump in transactions. And I do think we will see a decline in prices. And the debate is about how significant that decline will be. Obviously, the decline will be bigger if the shutdown goes beyond the 6-month period that the bank payment holidays relate to and the keeper scheme relates to. So if it goes beyond September, then we've got problems here and prices will come down a lot as people start defaulting on their loans. But if the shutdown ends before then and many of us can go back to our jobs, and many of those who aren't getting paid by the employers start getting paid again, then I think that might head off that worst case scenario. But I've been saying a range of falls around 5 to 20% for place like Perth, which has had falls over many years. I think it's probably stopped falling. I think it might come off only 5%. It may not come off at all. Brisbane, Adelaide haven't had big gains over the last few years. They're probably, if they're going to come off, only 5% or so. Sydney and Melbourne are probably the ones that are most vulnerable, where we might see falls somewhere towards the higher end of that range. So they're the ones to really keep an eye on, Sydney and Melbourne. If I move on to this, hopefully the situation we're going through won't be permanent. Certainly this situation here, there were some photos taken of people shopping at Walmart and all sorts of get-ups to avoid getting I don't know how that lady thinks the sponge is going to help it, but anyway, to help them avoid getting the virus. So hopefully what we're going through is not a permanent phenomenon. Many of those things won't be permanent. There will be lasting impacts from this crisis. I said before, lower for even longer interest rates. It's going to see investors become cautious yet again, like they did after the GFC. It's going to boost online retail sales. You know, another big chunk of Australians have gotten used to online spending. A bunch of us now working at home will think, well, I'd actually rather be in the office most of the time with my colleagues and getting out there, but by the same token, I don't mind the idea of being at home 1 or 2 days a week. So that might lead to further space savings in terms of office demand. Obviously, this is a bit of a blow to globalisation. You know, Australian government will say, well, you know, we're a bit uncomfortable having all these drugs and hospital gear being made in other countries. Let's bring some of that stuff back to Australia. It's probably going to boost the tensions between the US and China. We're already starting to see a bit of that. So these things are negatives in the sense that they're a bit of a reversal of globalisation. Obviously, more public debt. There's pros and cons with that. Probably more negative than positive, I think. Not so good for airlines. A lot of business people might say, well, I've got used to interacting on Zoom and video conferencing and so on. Maybe I don't need to do that international travel. So that could be a bit of a drag for them and maybe higher inequality. So there are a bunch of negatives there. One risk, I think, in all of this is that President Trump wants to get re-elected at the end of this year. Historically, the odds are now stacked against him. I'd say he's probably got a 35% chance of getting re-elected simply because presidents don't get re-elected when unemployment goes up in the period before the election. And that's what we're seeing in the US. And you've got a lot of Americans who don't have health insurance either, and they might hold that against him. So there is a risk that he says, okay, I'm going to create some sort of distraction here, try and rally us all around the flag, maybe picks a fight with Iran or China or Venezuela. Hopefully not, but that is a bit of a risk to keep an eye on. So I won't go through all of those things there. Key things to watch, I think, in Australia is household debt, what happens on that front. The sooner we can end this shutdown, the better, in terms of getting people earning incomes again and servicing their loans. Does the Eurozone hang together? I think it probably does. They usually get there in the end, but there's a bit of risk around that. They may not provide this degree of help for Italy and others that they should. And corporate debt in the US is also one to keep an eye on. So if I might just move on yet again, I think these are things that are very important. So what I've talked about is my view of the outlook, but it is very hard to get market timing right in the short term. And I think these things are very important for investors to keep in mind, critically important. We have to make the most of compound interest. I'll zip through these and I've got some charts which I think are worth looking at. If we don't, then we're not going to have a good retirement. And you make the most of compound interest by having exposure to growth assets where high returns compound on high returns over turn. Don't get thrown off by the cycle. So many times you hear people, they got out in the GFC, they got out in 74 and never got back in again. Try and invest for the long term, diversify, don't have all your eggs in one basket. Turn down the noise, very distracting what we're going through at the moment. Sometimes you've got to try and turn that down. Buy low and sell high. Often people just sell at the bottoms and buy at the tops. Beware the crowded extremes. Everyone was most bearish, guess when? Back in late March when share markets were around the lows. Focus on things you understand and seek advice if you don't think you've got enough expertise. This is compound interest. I mean, this is critically important. If you go back through the history of the Australian share market or any share market in a major, relatively stable developed economy, you see a long upwards trend outperforming safer assets like cash and bonds, but interspersed by occasional sharp pullbacks, like in 73, 74, the GFC, like last month. So these things happen, but the trick is to stay there for the long term. 3 years into my career, we had the 87 crash. And if I'd had access to my super and thought, gee whiz, what the hell am I doing with 70% in shares? I might have switched it all into cash and not got back in until maybe the late 1990s when the tech boom came along. But that would have really dampened my the funds I would have today, because I wouldn't have had the benefit of compounding on the back of investment going on through that period into the share market. So very important to make the most of compound interest. Next slide, I think, is coming. Just allow that there's a lot of short-term volatility in investment markets, particularly shares, but rolling 10, 20-year, 40-year returns, I say 40 because that's the life, working life of many Australians, is pretty good. But we always see this volatility. It's not that unusual. It's what happens in the share market. In fact, the good returns you get over the long term, the price we pay for that is volatility in the short term. That invest for the long term chart, this is another version of that. This chart for Australian shares goes back to, again, 1900. It's a price index. You can see lots of setbacks, including Spanish flu, World War I, global financial crisis. But again, shares climbed that wall of worry over very long periods. And this is the cycle we go through. Lots of people were quite happy at the start of the year. Maybe not euphoric. I don't think we had euphoria going into the start of this year, but people were feeling reasonably comfortable about their investments, about the share market. And then, of course, markets started coming down, a bit of wobbles at the end of January, going to February, a bit of anxiety. And then, of course, we really started coming down through late February into March, fear, denial, desperation, panic, capitulation, depression. So this is the cycle we go through. Just bear in mind, the trick is that the best opportunities are at the lows and the worst opportunities are at the highs. So if we move on, there goes my phone. This often happens. I'm just going to answer that and hang up. I should have anticipated that. Downside of working at home. Timing is hard. Now, I'd love to be able to get time markets perfectly, but the history of this tells us we can't. If you go over the period over the last 25 years, average return on Australian shares has been around 8%. And oh my God, that's just the way it is. If alternatively, this is going to get really distracting, this phone here. I'm going to do some timing there. Let's say I can get it right and miss out on the worst days. If I miss out on the 10 worst days, my return will jump to 11%. If I miss out on the 40 worst days, my return will jump to almost 16%. That's the yellow bars. If alternatively I get it wrong, get my timing wrong, and miss out on the 10 best days, my return goes down to 6%. If I miss out on the 40 best days, my return goes down to 2%. I think timing markets is very hard. And yes, we like to think we can get it right. In hindsight, it often looks very easy, but the reality is it's actually quite hard. So I might wrap it up there. I think very important to turn down the noise. I'm looking forward to the next series of The Bachelor when it starts up soon, hopefully. Bit of distraction in the night times. If we wrap all this up, that's my summary there. Yes, we're going to have a big hit to economic activity in the short term, but I am getting a little more confident that through the second half of the year, we'll see a rebound, and that ultimately should underpin share markets on a 12-month horizon. So I'm happy to take any questions. So it's back to you, Katarina.
Thanks, Shane, and thanks for that. So we've got quite a few questions to get through. One of the first ones is talking about the situation in Australia from a health perspective is obviously significantly better than some of our global counterparts, but markets are equally volatile. So does our management of the health situation have an actual economic impact?
I think it has a big economic impact because if we hadn't got the health situation under control, we would have seen many more deaths in Australia, but we'd be looking at a much longer shutdown period and a much bigger hit to our economy. So I think managing the health situation has been the right thing to prioritise through this period. And I think we've done a pretty good job on that front. And I think ultimately that will put Australian assets in good stead. You might say, well, how come the US share market from its low in March has gone up 28%? We've only gone up 21%. I think that's partly because, or largely because, they're doing a lot more money printing than we are. in Australia. Their central bank, the Fed, is doing more money printing than we are. But I think getting the health situation under control, making sure the hospital system can cope, I think leaves us in good stead for a better future in terms of being able to open the economy up again.
Okay. Next question, Shane. Can the Australian economy fully recover without tourism?
Well, that's a good question. I think it can, but it will take a little longer to do that. We are net exporters. More foreign tourists come to Australia than leave. It's the same with higher education, and tourism will probably be one of the last things to come back. But by the same token, I think what's important here is that we really started getting worried about our economy as we went through March, and that was because of the shutdowns. It wasn't so much because of a 0.2 or 0.3% hit due to an absence of, say, Chinese tourists. It was mainly because of the really big hit coming as we had to stay at home. So I think, yes, we can recover, but to get back to our normal state of growth and to optimise growth in Australia, yes, we do need to see a return of international tourism, and unfortunately that's going to take a little bit longer.
Okay. You did answer this throughout the webinar, Shane, but there's quite a few questions for it. Can Australia afford to pay this bill in recovery?
I think it can. And the reason I would say that is that the US, Europe and Japan have much higher levels of public debt than Australia does. So Australia has net public debt. This is all government debt owed by the states, less the assets of the Reserve Bank and the Future Fund, of around 22% of GDP. In the US, Europe and Japan, it averages around 80%. Obviously a lot higher in Japan and a little bit lower in Europe, but averages around 80% of GDP. So our starting point is relatively low, and it's below where it was at the end of World War II. So I think we're in a reasonable position to pay that down. The other thing to note here is that the Reserve Bank is helping out a little bit. It's not directly financing government, as it pains to stress. It buys those bonds in this so-called secondary market after someone else has bought them off the government. But if the RBA buys government bonds, it's paid the coupon interest payment. It costs the Reserve Bank nothing to buy those government bonds because they're using printed money. So the interest payment actually goes to the profit of the Reserve Bank, which is paid back to the federal government as a dividend. So oddly enough, those bonds are costing the federal government, will end up costing the federal government zero in terms of the cost of servicing them. And not many people seem to realise that, but that's the way it's going to work out. Now, that's not all the debt that they've taken on. It's just a portion of it, i.e. the portion that the Reserve Bank has been buying indirectly in the money markets.
Okay. Now, while we're on printing money, are you concerned about a hyperinflation risk and as a knock-on effect of that, higher interest rates?
Hyperinflation normally occurs in countries where there's not a lot of spare capacity. So Zimbabwe, they wiped out their farms. And then the government thinks, well, how do we pay our public servants? We'll just print some money, and they go to the shops. There's nothing there, so the prices go up. Weimar Republic in Germany after the end of World War I, they didn't have a lot of spare capacity. The government resorted to printing money. That results in more money chasing a limited amount of goods, so the price of the goods go up. We're not seeing that in Australia. We have a low inflation problem in Australia, and we have a lot of spare capacity. So if there's more spending, which might be supported by some of that money printing, then yes, it will use up some of that spare capacity. But until we use up the spare capacity, it's hard to see inflation picking up and hard to get hyperinflation coming through. So I think it's a risk for the medium term, beyond 3 years, if this increase in money supply is allowed to be sustained. But it's sort of an issue for a few years down the track once we return to more normal levels of economic activity. And I should point out that don't forget US, Europe and Japan have all done quantitative easing, money printing over the last decade, and yet they didn't end up with much of an inflation problem.
Okay. Next question for you. How do you see commercial property faring through this period?
It's going to have a rough period. If I run through the three main sectors there of commercial property, retail will be the hardest hit for obvious reasons. It's getting hard hit right now because a lot of shops are shut. But also when the shops come back and we can get out there again, a lot of people will be, there'll be another bunch of Australians used to shopping from home. So that will impact traditional bricks and mortar retailing. I think that will have a short-term further impact on retail shopping centres. I think it's really up to those shopping centres to repurpose themselves and shift more, as they have in recent years, towards becoming entertainment venues. So you go in there for a whole bunch of other reasons, as opposed to just doing your shopping, and that utilises that space. And I think we're also in much better shape than the US, because we don't have anywhere near the amount of square metres devoted to each person in Australia of retail shopping centres that the US does. Office property is also at a little bit of risk, because more and more Australians might say, oh, this working from home thing isn't too bad. Not 5 days a week, but maybe 1 or 2 days a week. So that could have more of an impact there. But again, I think this talk of everyone working from home is probably a little bit exaggerated. People could have done that over the last decade or so, and it didn't really happen. So, but it will have some dampening impact in the short term. Industrial property, I don't see a major impact. In fact, it's a positive impact for industrial, because to the extent that more economic activity goes through online purchases, then industrial warehouses will be in greater use.
Okay, we've got a couple of questions coming through about debt levels in the US as well, Shane. Are they concerning to you post-pandemic?
Well, the debt levels in the US are much higher than they are in Australia, and yes, they do concern me. And now I'm more concerned because not only did President Trump ramp up deficit spending 3 years ago when he came into office, and now, of course, they've done some more. I think what they've done recently is necessary to help shore up the US economy through this shutdown period. But yeah, it will leave them with a bit of a hangover. But again, it is just worth stressing that Americans borrow in US dollars. They're borrowing at very, very low interest rates. So the cost of servicing that debt is incredibly low. And as I said before, to the extent that the central bank has some of that debt, it's quite conceivable that it may never be paid down. And the balance sheet of those central banks, the US Federal Reserve, just ends up being a lot bigger than it used to be.
Okay.
I think the real threat there is if the US economy gets back to a strong level of economic activity, spare capacity is used up, unemployment goes back down, and wages growth starts to pick up, and money starts circulating a lot more, then the central bank has to get some of that money out of the system to avoid a sharp pickup in inflation. That's probably the biggest threat from all of this.
Okay.
As long as they do that, we should be okay.
Okay. Now, back in Australia, how will this recession compare to others? No, I've asked you this one before. It's
going to look horrible. I mean, I've been around for 3 of them, believe it or not. 74, there's a little one in the late 70s. That's 4 of them then, early 80s and early 90s, and they all felt bad, particularly the one in the early 90s. But this one will be a lot worse than those in terms of magnitude. So the biggest post-war contraction in economic activity in Australia was about 3.5% in the early 80s recession. That recession and the one in the early 90s saw unemployment go to 10%, and the one in the early 90s was 11%. This time around, I think the hit to the economy will be a lot greater. It won't be 3.5%. It's going to be somewhere between 10 to 15%. So therefore, it'll be a much bigger hit. But it is just worth stressing that hit is coming because we've been told to stay home to get the virus under control. It's not because the champagne was bubbling over the side of the champagne glass, as Paul Keating put it back in 1989. We haven't had an excess that we need to work through to work off. Therefore, we should be able to recover faster. So yes, on the one hand, it's going to look terrible. It's going to feel more painful for many Australians. But on the other hand, we should be able to bounce back faster. The other big difference between now and 1932 or 1930 or what have you is that government stimulus response has occurred a lot faster. Interest rates at zero, money printing, fiscal stimulus. You didn't have that going into the 1930s depression. In fact, they were tightening monetary policy and they were tightening fiscal policy. And we didn't have that going into the recessions of the early 80s and 90s. So the fiscal and monetary response has been a lot more positive this time around and should also help minimise the downside.
Okay, a similar question now to the one that was on tourism. Do you foresee any negative impact with the restrictions that would be on migration at the moment?
Yes, it will, and that will impact the property market. I think I forgot to mention that as a negative. Right now, we're not seeing migrants come to Australia because of the travel ban. Therefore, it follows that to the extent we have 200,000 people come in as migrants, those people demand housing. We're seeing, for every quarter, it's about 50,000 people a quarter. That means less demand for housing. So that's another drag on the property market in the short term.
Okay. a big question for you now, Shane. So good luck with this one. What is the risk of the US-China conflict beyond the trade war?
I think the risk of US-China conflict is rising. I don't think it will turn into a physical or so-called hot war, simply because both have nuclear power, so nuclear weapons, so they're not going to do that. But I think in the run-up to the presidential election later this year, that tension will start to hot up again. It's already doing that, with President Trump seeking to deflect blame back to China. We'll see a return to the US-China Cold War. It's not helpful from a global perspective. I do think, though, a lot will depend after November on who wins the election. If President Trump wins, then it will probably continue to escalate as an issue as we go through into next year. But if the Democrats win, then I think they'll probably pursue the issue through more diplomatic channels, seeking more an approach of cooperation. And so therefore it will become less of an issue for markets.
Okay. I know that we're not going to pick the bottom here, but what one of the questions through is, what would be the clearest sign that markets have hit their bottom?
Yeah, that's a good question. I'd go back to those signposts. Yeah, clear evidence the virus is coming under control. And if we get news of a vaccine, I reckon that'd be that. Yeah, the people would really relax after that. But that may still be way off. Then I'd look for evidence that we've seen severe investor capitulation. People saying, I don't want to be in shares again. Normally when people get really worried about the share market, that's a sign of a market bottom. Maybe we saw that on March the 23rd. You can debate that. The other one would be, I think, clearer evidence the economic indicators are losing downwards momentum. So you may recall that one I had for Australia, which had that weekly plot of various indicators combined together. It looks like it's bottoming. But if the US one looks like it's starting to bottom out and maybe starting to head higher, then that would be a positive sign of a market bottom as well. So there'd be a bunch of things to look at. I reckon it is very hard to pick market bottoms. One of the best things you can do is dollar cost average. When you have these big dips, you sort of average in over several months.
Mm-hmm. Okay, we've got time probably just for one more question, Shane. You did touch on this, but there's a few people asking, do you think supply chains will be nationalised post-pandemic?
To some degree, they will be nationalised, and I'd see that as bringing supply chains back on board. Not for everything, but I think for critical items, particularly health-related items, medicines and so on, I think we'll see a shift back towards local production. I don't know whether that's going to mean that I'm going to be driving an Australian-made Holden again. You never know. But I am driving an Australian-made Holden. It's just that it's now almost 3 years old, so which is kind of depressing that they shut production down of those cars. But I think we need to keep the global situation going. We do benefit from free trade. It has led to higher quality cars, lower cost cars, and all those sorts of things. But yeah, it has taught us a bit of a lesson that we need to have essentials. We need to produce some of those things ourselves. So I think it's about striking the right balance there.
Okay, wonderful. That's all we have time for. Thanks for that insight today, Shane. As always very encouraged by your ability to see past panic and to turn down the noise, as you say.